Pfizer stock is now trading at its lowest price in over a decade. Look at this. In the last year, they're down over 17%. And if we look at the past 10 years, down 18.56%. But most of the sell-off has just come in the past 3 or 4 years. We can see at its high in 2021, it was trading over $52 to $53 per share, and it's come all the way down to $24.86. Now, trading at this price also gives the company its highest starting dividend yield in over a decade. The current yield is sitting at about 6.77%. And to put this into context, if we jump over to my dividend breakdown sheet and plug in PFE, what we can see is, historically speaking, the company has been increasing their dividend payouts every single year. So we're talking about a very high yielding stock now that has a 10-year dividend CAGR of about 5.5% and a 5-year dividend CAGR of around 4.2%. And here on Seeking Alpha, if we quickly jump over to the valuation tab, we can see they're trading below their 5-year average non-GAAP price to earnings. So we have to ask ourselves, is Pfizer a massive opportunity at these prices to buy a dividend growth stock with a starting dividend yield above 6.7%? There's plenty to look at, so let's go ahead and jump into it. Now, the first question we have to ask ourselves is, what is the reason for this massive sell-off that we've seen just in the past few days? Look at the past 5 days, down 5%, and in the past month, down 15%. And keep in mind, the company just recently released their latest quarter's earnings when they actually saw beats on top and bottom lines by a huge amount. Look at this. Revenue was a beat by over $2.84 billion, and earnings per share was a beat by around 48 cents. And to put that beat into context, if we scroll down, here's what analysts are expecting for Q3, around 61 cents, and actual came in at $1.06. So this was a huge beat for the company, and they've actually seen beats 3 quarters in a row now. So again, what's the reason for the sell-off in the past month? And I think this headline pretty much paints the picture. Big Pharma reckoning looms with RFK Jr. eyeing Pfizer. If we come down, we can see RFK Jr.'s potential appointment as health secretary could impact Pfizer in quite a few different ways. It could impact things like drug approvals, advertising revenue, legal risk, and obviously all those things would affect the underlying fundamentals, impacting the share price for Pfizer. And keep in mind, in an interview the other day, RFK Jr. did state that he would be going after companies like Pfizer. So the reality is, these aren't just scary headlines. It isn't just speculation. He has made it clear that's what he wants to do. And obviously, as we can see, that has spooked a lot of investors in the past month. Now, if we look at Pfizer from a dividend perspective, again, that's a high starting dividend yield. How sustainable is that dividend? If we jump over to my dividend breakdown sheet, we've already plugged in the stock ticker. And like always, you can download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet. Then you can head over to tickerdata.com at the link in the description. Now, like I've already pointed out, very high starting dividend yield now, sitting at 6.76%, the highest yield in over a decade. And they have a history of growing those dividend payments. Look at this. Back in 2013, they're paying out about 91 cents per share. At the end of 2023, it was $1.64, and now $1.68. And if we look at the free cash flow the company's generating versus the dividends paid out, remember, dividends are paid out of free cash flow. A company needs to be generating more free cash flow than the dividends they pay out for those dividend payments to be sustainable. And for the majority of the past decade, this was no problem for Pfizer. And in fact, 2021, we can see the company generated nearly $30 billion in free cash flow, while dividends paid out was only around $8.7 billion. And if we look here, we can see that gave them a free cash flow payout ratio of just 29.22%. So that means they only use 29% of their free cash flow to pay out dividends. But the past few years have told a different story. We can see 2022, still a good year, but free cash flow declined while dividend payments increased. And in 2023, the lowest free cash flow year for the company in a decade, only $4.8 billion, while dividends paid out was over $9 billion. That's a huge problem for the company, and it's not sustainable over the long term. Now, Pfizer hasn't reported Q4 yet, so we don't have full 2024 data, but what's been going on with the company the past 3 quarters? Because again, this will tell us a lot about the sustainability of the dividend. And again, using the ticker data add-on, I was able to automatically import this into my spreadsheet so we can start to break this down and chart it out. Now, I know this looks complicated, but again, we really just want to focus on these most recent quarters in 2024. And if we look in Q1, we can see free cash flow generated was only $387 million, while the dividends they paid out that quarter was over $2.3 billion. Free cash flow in Q2 was negative $2.4 billion, a disaster quarter, while dividends paid out was $2.38 billion. Now, Q3 was a little bit better, and like we saw, it beat analyst expectations. They generated about $6 billion in free cash flow, and dividends paid out was still about $2.38 billion. Now, like we just saw in 2023, they paid out over $9.2 billion in dividends, and it'll be slightly more in 2024 due to that recent dividend hike. And so far in 2024, the free cash flow has not covered those dividend payments, especially because of that quarter with negative free cash flow in Q2. Now we can see from the management team, based off their strategic capital allocation decisions, they really do not want to cut this dividend. They want the dividend to be sustainable because they know it's the reason a lot of people invest in the business. And the reason I can tell this is if we look at their recent earnings report and look at their capital allocation slide, we can see right here, they don't have any share repurchases planned in 2024. Most companies that are in the same business stage from a maturity standpoint as Pfizer are going to be buying back shares on a pretty regular basis, but that's not the case for Pfizer. When we think about the Pfizer business model, a pharmaceutical company, they have to heavily invest back into the business in order to grow because the company's future growth is always all about what is in the company's pipeline. So we can see year to date after Q3, they've reinvested about $7.8 billion back into the business for research and development. So far, they've paid out about $7.1 billion out in dividends. Then we can also see they paid down about $4.4 billion in debt. And so if we quickly glance at my balance sheet breakdown, let's go ahead and plug in PFE. And what we can see when this data loads in, the current ratio is currently sitting right at 1.00. So the company's on the brink of kind of being in an unhealthy situation when it comes to their current short-term obligations. Again, current ratio is simply your total current assets divided by your total current liabilities. And if we look at this charted out over the past decade, for the most part, they're in a decent range above 1.3. But in recent years, we've started to see it decline. Now going back to the capital allocation plan, again, research and development. This is huge for pharmaceutical companies like Pfizer, like Johnson & Johnson. And it's imperative that they find some profitable drugs moving forward because they have some headwinds on the horizon. Let me show you what I'm talking about. One of the primary risks Pfizer is currently facing is expiring patents for several key products. We have 6 products that are listed out right here, and they're all expected to lose their patent sometime between 2025 and 2027. Now, here's why this is important. During Q3 of 2024, they generated about $5.6 billion in revenue. Well, that's about 1/3 of the company's total revenue, so we're talking about a significant chunk. Once they lose their patent, revenue will undoubtedly go down for each of these products. So how is revenue going to grow when these expire? What are earnings expectations like? And before we look at that, let's jump over to my stock screener. Come up here and plug in PFE, Pfizer. And what we can see with Pfizer is over the past decade, earnings have been all over the place. And obviously in 2021 and 2022 with the new vaccine, profitability was really high. Then we saw a huge decline in 2023. Earnings per share was all the way down to about 38 cents per share. Free cash flow per share was down by a large amount as well. We can see in 2023, free cash flow per share was around 85 cents. Now, if we look at it in the trailing 12 months, it's up to about $1.45. So we are starting to see some recovery, but still not to the levels it was pre-pandemic. Now, if we jump back over to Seeking Alpha and look at how earnings are expected to grow moving forward, if we start to scroll down, we can see they're expecting pretty massive revenue growth in total for 2024. And while that's great, really all that does is start to put them closer to what it was pre-pandemic levels. And then if we look what's happening after that, earnings expectations really start to slow. We can see pretty much no growth projected after that. Then we have low single digit to even negative growth after that. Now, the reality is when we're talking about companies like Pfizer, Johnson & Johnson, or even AbbVie, it can be really difficult to project growth because again, it's always going to be about what is in the pipeline for these companies, but it's clear earnings growth expectations are not high for Pfizer. And what this tells me is people aren't really confident in the current pipeline. Now, if we jump over to my profitability sheet, there's actually a bright spot worth pointing out. If we plug in Pfizer, the first thing that jumps out to me is a massive decline in the gross profit ratio since 2020. We can see the gross profit ratio had a 10-year average of about 74%, but last year it was all the way down to 49.25%, which is a massive decline and a huge red flag. But here's the bright spot. Let's compare the most recent quarter to last year's gross profit ratio. Again, we can just use the ticker data function. We'll come up here and select Pfizer. We want gross profit ratio 2024 and the most recent quarter, which is Q3. And we can see it came in at 70.27%, a massive increase from last year's. But what about Q2? What about the previous quarters? Let's change this to Q2, and we can see it was 62%. If we change it to Q1, we can see the gross profit ratio was 70.56%. So margins are looking drastically better than they were last year. Now let's start to talk about the valuation. Like we've already seen, Pfizer's down over 17% in the last year. In the last 10 years, its lowest price ever, around $24.86. And if we look at this company from a free cash flow yield perspective, come over here. Again, we can see for the trailing 12 months, the company has a free cash flow yield of about 5.84%. So for every $100 you invest into Pfizer right now, it's going to produce about $5.84 in free cash flow. And ideally, when we do that for these companies, the free cash flow they produce over time will continue to increase. So generally speaking, that is a pretty solid free cash flow yield, but again, growth rate projections are fairly low. Now, if we jump over to my valuation spreadsheet, again, we'll go ahead and come up here and plug in PFE and hit enter. And if we look down here, we can see the beta for the company sitting at about 0.62. So you should see less volatility with this company than that of the market. Now, the first valuation we're going to look at is going to be Graham's valuation. And if we go ahead and zoom in over here, we can see the formula laid out for us right here. If we plug in all these variables, the estimated earnings per share for the company, which by the way, it is worth pointing out, in this most recent earnings report, the management team actually did increase their 2024 revenue range guidance. We can see they adjusted it to about 61 to 64 billion when previously the low end was about 59.5 billion. And the same happened with adjusted diluted earnings per share, bumping it up to 275 to 295, which is a good sign. So if we jump back over to our valuation spreadsheet, we can see the ticker data function is telling us the estimated earnings per share average for the next year is about 289, which is kind of in the middle of what we saw of that range that the management team gave us. If we go with a growth rate projection of about 4 and also divide by the current yield on AAA corporate bonds, we come to an intrinsic value of around $29 per share. Now, typically the next valuation we look at is going to be our DCF model, but this is a difficult valuation model for a company like Pfizer in their current situation. So I think a better way to look at this is actually going to be a reverse discounted cash flow analysis. And what this does is it tells us how much free cash flow growth is the market pricing into Pfizer stock. So right now, we can see with 0% free cash flow growth, the company is pretty much worthless. Now, the current price is about $24.86, so what this tells us is the market is valuing in some free cash flow growth. Now, in the case of Pfizer, this is going to be a unique situation because we can see right here 2023 free cash flow significantly lower than it had been over the past few years. But like we've seen, a recovery is expected. So this is a case where we have to remember that valuation is more of an art than a science. It's not going to be the exact same every single time. So maybe for 2024, we bump this up close to what the pre-pandemic levels were and put it at about 10 billion. And what we can see this does is our reverse DCF is now telling us with no free cash flow growth priced in, the company's worth about $12.57. So let's start messing with this growth rate to see how much growth is priced in. If we bump this up to about 3%, it goes to $17, 5%, $21. If we bump it up to 7%, it gets slightly above that current share price. So if we bump it back down to about 6.85%, we get right at that current share price. So our reverse DCF is telling us, assuming that Pfizer gets back to that pre-pandemic level in 2024, after that, the market is saying they're expecting about 6.85% average free cash flow growth through the year 2032. Now the question you have to ask yourself is, do you think it'll be more or less than that? Because if you think it'll be more, then the company's undervalued, and if you think it'll be less, then the company is overvalued. Now the last valuation model that I want to look at is going to be our dividend discount model, and this values the company based on how much they pay out in dividends and how much that dividend is increasing over time. And we can see in the scenario, assuming a dividend growth rate of about 2.75% and a discount rate of 8.5%, the company's worth about $30 per share. Now, like I've already pointed out, the reality is I think they're in a little more of a difficult position than a lot of people are realizing when it comes to that dividend. It's become clear the past couple of years have been difficult for the company in regards to paying out that dividend because free cash flow has clearly not been covering those dividend payments. If we look in 2023, free cash flow was about $4.8 billion and dividends paid out was over $9 billion. And depending on how Q4 goes for this company, that could be the case again. And if we see that happen again in Q4, that would start to put me at a point where I'm getting pretty concerned about the sustainability of this dividend and especially the sustainability of increasing that dividend. Pfizer's already not buying back any shares, even during a time when a lot of people feel like the stock is undervalued. And they're also almost paying out as much in dividends as they're reinvesting back into the business, which is probably not ideal for their business model. So keep all that in mind when looking at the dividend discount model. But if we jump over to the output tab and average those two valuations together, we come to about $29.52, which compared to the current price at $24.86 is a difference of almost 16%. So yes, it does look like the company may be undervalued, but there's a lot of risk with this stock right now. If we come over here and look at with a 10% margin of safety, the acceptable buy price is about $26.57, which we are getting a buy signal. But again, I want to make it clear there is a lot of risk priced in. As for me, I don't want to get close to a stock that I have concerns about the dividend moving forward. I much prefer predictability and stability with my investments. Now, one more key highlight that is worth pointing out is if we look at insider purchases for this company. Now, there hasn't been a lot of activity over the past year for this stock. And actually, if we scroll down, we can see there was a recent purchase, but it was only worth about $28,000, which is pretty insignificant in the grand scheme of insider purchases. But if we start to scroll down and look at the past year, there have been quite a few sales from insiders. Pretty interesting. So just something to keep in mind. So the reality for Pfizer right now is, yes, maybe it is a little bit undervalued from a fundamental standpoint, but there's a lot of fear priced in. And I know we always say, be greedy when others are fearful and fearful when others are greedy. But I think the reality is this fear could be warranted. We really don't know yet what the implications of RFK becoming the health secretary could be. And even with all that alone, I do also have some concerns about the sustainability of the dividend. So Pfizer is definitely in an interesting position right now. If this does turn out to be a successful turnaround play, people are getting a company that has historically increased its dividends pretty consistently at a very high starting dividend yield. But then on the flip side of that, if the company doesn't do well and we see some complications due to RFK, I think they could eliminate the dividend altogether. Now, I don't think that would happen for the next couple of years, if that were the case. It would likely take some time, but again, it is something to keep in mind. So go ahead and let me know what you think of Pfizer in the comments down below, and like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.